Forget everything you thought you knew about central bank policy just being about interest rates.
Right.
Imagine two powerful forces. One we know well. One, maybe less so, hitting the economy, at the same time and creating these unexpected ripples, especially in a market most of us deal with everyday housing.
Yeah, that's a big one.
So what happens when the Fed doesn't just jack up borrowing costs, like at the fastest pace in 40 years,
which was already huge,
but also starts to actively shrink its massive balance sheet?
That's the quantitative tightening, or QT, piece.
Exactly. The sources we've got really dive deep into that, showing how this QT is hitting U.S. markets, creating distortions, interacting with other big economic forces, maybe in ways people didn't fully expect.
Yeah, it's not always straightforward.
So we're going to unpack the real-world effects, look at some really fascinating historical parallels.
They're interesting.
Explore how the government's own finances fit into this picture, which is critical.
Absolutely crucial.
And even touch on what it means for the U.S. dollar globally. Ready to dive in?
Okay, let's do it. Let's maybe start by unpacking this dual strategy the Fed's been using, really firing on both cylinders since, early 2022?
Right, simultaneously.
On one hand, you've got the tool everyone knows, the one that gets all the press, rapid interest rate hikes.
A classic move.
Exactly. And the Fed went in hard, started in March 2022. And over just 16 months, they pushed up the Fed funds target rate by, get this, 525 basis points.
Wow, 5.25%.
In just over a year. To give you some context, that's the highest and fastest rate increase we've seen in 40 years. The goal was clear. Cool demand fast, get inflation down.
Yeah, that's the one that dominates the headlines, right? You see it immediately in car loans, credit card rates.
Yeah.
Even savings accounts finally started paying something.
Yeah, finally off zero.
But that other prong, quantitative tightening, QT, it's much less discussed and often feels more, technical.
It does. And maybe because of that, its real-world impact is less understood by, the average person.
So what is it exactly? Reversing QE?
Precisely. QT is basically the process of undoing quantitative easing, or QE. Remember during QE, especially after 2008 and during COVID.
The Fed was buying up bonds like crazy.
Trillions of dollars worth. Government bonds, mortgage-backed securities. The goal was to push down long-term interest rates, inject cash, liquidity, into the financial system.
Right, support the economy.
QT is the mirror image. It means slowing down those purchases, then stopping, and then actively reducing the Fed's holdings as those bonds mature. They don't reinvest the principal, so it's effectively pulling money back out of the system.
Okay, so they started winding down purchases first.
Yeah, the transition began November 2021 with tapering.
Yeah.
But the active reduction phase, where the balance sheet actually started shrinking, officially kicked off in June 2022.
Okay, so you got the explicit cost of borrowing soaring from those rate hikes. And at the same time, the Fed is pulling back this massive underlying support it had been giving the bond market through QT.
It's a powerful combination.
And the sources we looked at make it pretty clear. This 1-2 punch hit one specific market, one that touches most Americans directly, particularly hard.
Oh, absolutely. The housing market, it's been hit exceptionally hard by this combo.
Just the rate hikes alone must have been a shock.
For sure. Just the rapid rate hikes themselves caused this sudden, really dramatic surge in borrowing costs. We saw mortgage rates, they basically doubled in about 6 months back in 2022.
Doubled in 6 months.
Yeah. That alone is just a massive shock to affordability for anyone thinking about buying a home.
And QT wasn't just sitting on the sidelines here, was it? It had a direct impact, especially on the plumbing of housing finance.
That's exactly right. Since June 2022, when that active balance sheet runoff started, QT has effectively canceled out or withdrawn over $300 billion of market support specifically for mortgage-backed securities, MBS.
Okay, remind us what MBS are again.
Sure. They're essentially bundles of individual mortgages that are packaged together and sold to investors on the bond market. They're a key financial pillar, really, for the whole housing industry. They help banks free up capital to make more loans.
Got it. And the Fed used to buy a lot of these.
They were the biggest buyer for a long time during QE. So when the Fed stepped back and started actively letting its MBS holdings shrink, the demand dynamics shifted dramatically.
More supply hitting the market relative to buyers.
Exactly. So MBS prices fell significantly, and their yields, which are what directly influence the interest rates lenders charge on mortgages, they soared. The sources noted MBS yields basically went up 6-fold from their lows.
6-fold. Wow. Okay, so let me get this straight.
Yeah.
You have the general impact from the Fed funds rate hikes, pushing all borrowing costs up.
Right.
And you have this specific withdrawal of support for MBS from QT, causing those particular mortgage-related yields to jump even more than other rates might have.
You got it. It's that combined effect. The rapid, broad increase in borrowing costs, plus the specific pressure on mortgage finance from QT. That's what created such a sudden, dramatic spike in the cost of owning a home.
And the sources mention something interesting about the coordination, or maybe lack thereof.
Yeah, they highlight that these two policies, the rate hikes and QT, they were sort of launched with slightly different primary objectives in mind.
Okay.
Rate hikes were laser-focused on hitting inflation directly, slowing down overall demand. Balance sheet reduction, QT, was maybe aimed more broadly at normalizing financial conditions, pulling back that excess liquidity.
And they weren't perfectly synced up.
Perhaps surprisingly, the sources suggest they were only loosely coordinated. And that lack of tight coordination might actually be why the damage to the housing industry ended up being potentially more severe, more disruptive than maybe anyone anticipated.
And we can actually put some numbers on that pain, right? The sources lay out some pretty stark figures for home buyers.
They are really stark. Let's take the monthly mortgage payment on a typical U.S. home, assuming, say, a standard 10% down payment.
Okay.
Since January 2020, just before the pandemic really hit. That payment has nearly doubled.
Doubled? Wait, nearly doubled.
Up 96.4%. 96.4%. It reached an average of 2,188.20 a month. Just think about that. For the same typical house price, the actual monthly cost to the buyer is almost twice what it was just a few years prior.
That's stunning. So someone buying the exact same house today pays basically twice as much per month as someone who bought in early 2020.
Essentially, yes. It's a massive change in affordability.
And I'm guessing incomes haven't exactly kept pace with that surge.
Not even close. The income level you'd need to comfortably afford that same typical home, that's surged by 80% since 2020, according to the data cited.
80%.
Meanwhile, median household income, well, that's only managed to rise by about 23% over the same period.
Okay, so the gap is just enormous.
It's a massive, rapidly widening affordability gap. It just makes homeownership completely unattainable for a growing number of people.
And there's a specific term one source used to describe this extra layer of cost on mortgages, something beyond what even the higher treasury rates would suggest.
Yes, they called it the QT surtax.
QT surtax, okay.
The analysis suggests that QT seems to have added this significant kind of measurable extra charge onto the cost of getting a new mortgage.
How so?
Well, mortgage rates are currently much higher relative to the benchmark treasury yields than they have been historically. That spread, the difference between mortgage rates and treasury yields, is wider than usual.
And that spread is the surtax.
That's how they frame it. And it's amplifying the stress on the housing market. The idea is it stems directly from the damage done to that MBS market when the Fed pulled back its support.
So what's the consequence?
It means that collectively, homeowners, consumers, are paying hundreds of billions of dollars more for home ownership through higher interest costs than they might have otherwise. And at the same time, investors holding those MBS bonds have suffered a similar penalty, right? Their bond values went down as yields went up.
And is this surtax just a temporary blip?
The sources suggest maybe not. It may persist for some time, unfortunately.
Okay, so just to recap that point, it's not just that overall borrowing costs are up because the Fed's fighting inflation. It's that they are up more for mortgages than historical patterns would predict. And that seems directly tied to QT messing with the MBS market.
That's a good summary of the argument, yes.
But the impact wasn't just on the cost of mortgages, right? The sources also talk about how this whole situation fundamentally warped the actual buying and selling, the supply and demand in the housing market itself.
Exactly. That combination, the high rates and the QT pressure, worked powerfully together to just crush demand for mortgages.
Makes sense. Too expensive.
Right. If you look at charts showing mortgage applications or new loan originations, they just plummet. Prospective buyers are either priced out completely or just unwilling to take on such huge debt costs at those rates.
Okay, so demand drops. Now, intuitively, you might think, okay, less demand means more houses sitting on the market, listings pile up. But that's not what happened.
No, fascinatingly, the opposite happened, because those higher rates also effectively froze the supply side of the market.
How did that work? The golden handcuffs?
Pretty much. Think about it. If you're an existing homeowner, maybe you were lucky enough to refinance or buy when rates were super low, say 3% or 4%.
Mm-hmm.
Why on earth would you sell your house now and move only to take out a new mortgage at 7% or 8%?
Right. The monthly payment difference would be huge, even for the same price house.
Exactly. The cost of just trading up or even moving laterally became prohibitive for millions of people. So this rate lock-in effect dramatically discouraged potential sellers. And remember, many sellers are also potential buyers.
So fewer homes listed for sale.
Dramatically fewer. The sources show charts with this persistent deficit in new listings compared to historical norms, and that led to a decline in the total number of homes actually available on the market.
And QT made this worse.
It exacerbated it, yes. By further hitting affordability and just generally gumming up the works of the market, QT added to this supply strangulation. The result is declining inventories and a market that the sources describe as deeply imbalanced and, frankly, illiquid.
Okay, so we have this bizarre situation, demand falling off a cliff because mortgages are unaffordable.
Yep.
But supply also freezing up because existing homeowners are locked in by their low rates.
Yep.
What does that do to house prices then? It's a weird tug of war.
It creates a really unusual dynamic. Normally, you'd think such a steep drop in available supply would push prices way up.
Right. Basic economics.
But in this case, the reduction in demand was even more powerful. So the net effect was, well, we actually saw home prices fall on a quarterly basis last year in some key indices, though it definitely varied by region.
So not a 2008 style crash, but
Right.
stagnant, depressed.
Depressed is a good word the sources use. The market isn't crashing, but it's performing well below its long-term trend line. It's stuck in this state of costly, illiquid gridlock, where very few people can afford to buy and very few existing owners can afford or want to sell and move.
And this gridlock, this unaffordability recipe, as one source called it, high rates, high prices relative to income, low inventory, it doesn't hit everyone the same way, does it?
Not at all. It creates a really significant unequal impact.
Yeah.
It heavily favors people who don't need to borrow money.
Cash buyers.
Exactly. High rates disproportionately hammer buyers who need a mortgage. That's most first-time home buyers, younger families, basically anyone who isn't already sitting on a pile of wealth.
Any specific examples?
Yeah, the sources point to some striking numbers. Like in Manhattan, the real estate market there in the fourth quarter of 2023, nearly 70%. 70% of all home purchases were made with cash.
70%.
When you see numbers like that, it tells you the market is effectively shutting out the non-wealthy buyer class. It creates this void and just makes wealth inequality worse.
And we have to remember, housing isn't just like an economic data point. For most American families, it's their main asset, right? Their primary source of wealth.
Absolutely. It's fundamental. So the distress in the housing market, the low sales volume, the difficulty getting financing, the sheer unaffordability it carries, this significant psychological weight, socioeconomic weight.
Yeah, it hits close to home, literally.
It really does. It touches directly on people's sense of financial security, their ability to build wealth for the next generation, their general feeling about the future, this kind of widespread stress in housing. It can absolutely have broader ripple effects, maybe even political ones down the line.
And there's also that indirect economic effect you mentioned earlier, the wealth effect. Can you remind us how that works?
Right. So changes in housing value, or even just the feeling about housing value and accessibility, have these well-documented effects on consumer spending.
Which drives the economy.
Drives about 70% of the U.S. economy, yeah.
Yeah.
So when house prices are rising steadily, homeowners tend to feel wealthier. That makes them more confident, more likely to spend money, maybe even tap into home equity.
But the reverse is also true.
Exactly. When values stall or fall, or when people feel locked into their homes and can't easily access that equity, it tends to put a damper on consumer confidence in spending. So the struggles in the housing market aren't just confined there. They radiate outwards and can significantly impact overall economic growth.
Okay, that gives us a really clear, if slightly grim, picture of the current situation, especially for housing.
Yeah.
Let's maybe connect this to the bigger historical picture now. Is this whole challenge of shrinking a central bank balance sheet after a huge expansion, is this totally new?
Oh, not at all. I mean, the scale of the recent QE expansion was pretty unprecedented in peacetime, sure. But central bank balance sheets, they've gone through major expansions for all sorts of reasons throughout history, way back before QE was even a term.
Like what kind of reasons?
Well, you had expansions driven by balance of payments issues back under fixed exchange rate systems. You had central banks financing government spending, especially during wartime.
Right, funding wars.
Acting as a lender of last resort during financial panics or crises. And then more recently, you have this category of demand stabilization, which is where the recent QE fits in trying to boost a weak economy.
Okay, so The reason for the expansion might differ, stabilizing demand today versus, say, funding World War II.
But the sources make a really interesting point here. They argue that the balance sheet expansion during World War II can actually be seen as a significant historical precedent. Not necessarily in intent, but in its functional consequences and the challenges faced when trying to unwind it later.
How so?
Well, the intent during WWII was clearly different, right? The Fed was actively helping the Treasury finance the massive war effort by keeping interest rates pegged really low through buying bonds. Recent QE was aimed more at stimulating a weak economy, fighting deflation risks, than countering the pandemic shock. But in both cases, the central bank ended up holding a huge amount of government debt on its balance sheet.
And the effect was similar.
The effect of those large-scale asset purchases was largely the same. It depressed bond yields, which, importantly, reduces the government's cost of servicing its debt. And that becomes really relevant when the national debt is high, like it was after the war and like it is today.
Ah, okay. I see the parallel.
So in that sense, the challenge we face today with balance sheet normalization, with QT, shares some surprisingly similar dynamics and, frankly, political pressures with that post-World War II period.
That is fascinating. So what can we learn from looking back at how they handled normalization after World War II?
Well, that post-war period offers some really crucial insights and maybe some warnings. Despite a lot of initial fear about surging inflation once wartime price controls were lifted and factories shifted back to consumer goods.
People expected prices to jump.
Yeah, but the Fed initially kept short-term rates, T-bill rates, certificate rates pegged at those very low wartime levels.
Why? If they feared inflation.
Primarily to keep supporting Treasury financing. The government still had a lot of debt to manage an issue. So the Fed continued to intervene in the government bond market, buying bonds to maintain those low-rate pegs.
Even while worrying about inflation.
Yes. Sometimes they tried to offset those bond purchases by selling some short-term securities to manage bank reserves, but the core mission was supporting the Treasury. The official line was always about, avoiding disorderly conditions in the government bond market.
But really, it was about keeping borrowing costs low for the government.
The fiscal consideration, keeping government borrowing cheap is clearly a dominant factor. It really overshadowed inflation concerns initially.
That sounds like a very tricky balancing act. And a familiar tension, maybe. The Fed's inflation mandate versus the government's financing needs.
It absolutely is. It raises this enduring question about the practical independence of a central bank, especially after it's been heavily involved in facilitating government borrowing through asset purchases.
So how did they eventually break away from those pegged rates? What changed?
Interestingly, the shift away from pegged rates, which did eventually happen, wasn't really triggered by the size of the Fed's balance sheet itself. It was driven more by a fundamental shift in expectations.
Expectations about what?
Inflation. The market, the public, they shifted from worrying about post-war deflation, which was the fear initially, to firmly expecting inflation. And this view got a huge boost from the outbreak of the Korean War in 1950.
Ah, okay. So war fears fueled inflation fears.
Right. And this change in expectations caused the velocity of money, how quickly money changes hands in the economy, to speed up rapidly. That, combined with the still generally accommodative policy, is what really fueled the big price surge back then. Inflation peaked over 20% in early 1947.
20%, wow. And the sources draw a specific lesson from this history for today.
They really do. The experience of the 1950s strongly suggests that fiscal considerations, the government's budget and debt situation, are incredible.
And thinking about historical QT episodes more broadly, were there other effects noted besides this fiscal entanglement?
Yes, there's another point raised in the historical analysis. Past episodes of central bank balance sheet reduction have often been associated with a prolonged period of bank lending being weaker than its historical trend, a sort of retrenchment.
Banks pull back on lending when the central bank shrinks its balance sheet.
That seems to be the historical correlation, yes. And it's noted as a potential cause for concern today, because if QT contributes to a significant slowdown in bank credit availability now, that could dampen economic activity even further, beyond just the direct effects of higher rates and the balance sheet shrinking itself.
Okay, this historical context really hammers home a point that seems central to the sources. You absolutely cannot look in monetary policy, the Fed's domain, in a vacuum. You have to consider fiscal policy, the government's domain, right alongside it.
You are spot on. Their interaction is absolutely critical, especially when you're dealing with these unconventional tools like QE and QT.
And the sources actually modeled this interaction.
Yes. A key finding comes from some pretty sophisticated modeling work discussed in the sources. It concludes that the macroeconomic impact of QT, what it actually does to inflation, growth, debt, depends crucially on the prevailing mix of fiscal and monetary policy. They call it the policy regime.
What kind of regimes are there?
Well, the model framework allows the economy to fluctuate between different states. You can have what they call a monetary-led regime. That's where the central bank is dominant, actively using interest rates to target inflation. And the fiscal authority Congress, the Treasury, is assumed to adjust taxes or spending as needed to keep government debt stable and sustainable. That's kind of the textbook ideal.
Okay, the Fed's in charge on inflation. What else?
Then you can have a fiscally led regime. Here, fiscal policy is maybe more dominant. Perhaps it's persistently stimulative, running large deficits, and the resulting debt dynamics start to have a bigger influence on inflation and expectations, potentially constraining what the central bank can do.
So fiscal policy is driving the bus more.
In a sense, yes. And of course, you also have the zero lower bound environment where interest rates are stuck near zero, which we were in for a long time.
And the effects of QT are totally different depending on which regime you're in.
Dramatically different. It's really fascinating. In that monetary-led regime, the model shows QT pretty much works as you'd intuitively expect. It helps reduce inflation. It might even allow the central bank to reach its inflation target with smaller rate hikes than it would need otherwise.
Sounds good. Any downsides?
Well, even in that best case scenario for QT's inflation fighting power, the simulations show it comes at a cost. It tends to increase the government debt to GDP ratio.
Interesting. Why?
It's partly because of how the fiscal side is assumed to react in that regime. The model assumes that to keep debt stable, taxes have to rise implicitly. Those tax hikes actually add to the drag on demand, reinforcing QT's disinflationary effect, but the overall debt level still ticks up during the QT process in the simulation.
Okay, but now the really interesting part you said. What happens to QT's effectiveness if the economy is in that fiscally led regime?
Yeah, this is where it gets really counterintuitive and maybe quite relevant for today. In a fiscally led regime where fiscal policy is maybe running hot, deficits are persistent. The sources find that QT has surprisingly little impact on inflation.
Really? Doesn't cool things down?
Not much, according to this model. The negative demand effect from the Fed shrinking its balance sheet, pulling money out, pushing up long rates, it's simply not powerful enough to counteract the stimulus coming from the fiscal side, maybe combined with negative real interest rates if inflation stays high.
So fiscal stimulus overwhelms monetary tightening via the balance sheet.
That's the finding. And what's more, in this fiscally led regime, the persistent rise in public debt itself, fueled by those deficits, starts to actively increase both actual and expected inflation. This can push up yield spreads even more and effectively mitigate or maybe even completely offset any disinflationary effect QT was supposed to have.
Wow. Okay, that is a really powerful finding. It basically says that if the government isn't getting its fiscal house in order, the Fed shrinking its balance sheet might be like pushing on a string when it comes to fighting inflation.
That's a pretty good analogy for the model's results in that regime, yes.
It suggests the government's budget decisions could be just as important, maybe more important in certain situations, than the Fed's balance sheet actions for controlling inflation.
Exactly. It fundamentally highlights the interdependence. You can't just assume the Fed can handle inflation alone if fiscal policy is pulling strongly in the other direction.
Did the model look at the recent crisis?
It did. They simulated scenarios similar to the COVID-19 crisis and the subsequent exit. The modeling confirms that the massive QE undertaken during the crisis likely did help lessen the severity of the economic downturn.
Okay, so QE helped on the way down.
But the challenge now, the one we're living through, is unwinding that stimulus effectively when you're facing high inflation, very large government debt ratios, and still a lot of liquidity sloshing around. It's a complex mix where that fiscal backdrop matters immensely for how QT performs.
Does it matter how fast the Fed does QT? Like, if they went more aggressively, would that make a bigger dent in inflation?
Yes, the speed of unwinding does make a difference, according to the models. But again, the outcomes are nuanced and depend on that regime context.
Okay.
Comparing different speeds, say a slow, gradual taper versus a really aggressive QT, the model suggests that faster unwinding can lead to stronger disinflationary effects, assuming you're in a regime where QT works at all. And it might allow the central bank to stop hiking its main policy rate sooner.
But there's a trade-off, I bet.
There is a significant one. Faster QT in these simulations actually leads to a slower overall deleveraging of the economy, meaning the debt to GDP ratio ends up higher with faster QT than with a slower approach.
Wait, faster QT leads to more debt. How does that work?
Wow. It's complex, related to the impact on growth and the government's financing costs. Aggressive QT also implies a faster increase in debt service costs for the government, partly because it affects the profits the Fed sends back to the Treasury.
Ah, right. Central bank profits. That's another layer connecting the Fed and the Treasury.
Absolutely. Because the Fed, like most central banks, remits its net income, its profits, back to the U.S. Treasury. QT directly affects those profits.
Oh.
Well, as the Fed's balance sheet shrinks, the interest it pays out on bank reserves held at the Fed, which is a liability for the Fed, might decrease, especially if QT allows policy rates to be lower than otherwise. That could boost profits.
Okay.
But the income the Fed earns from holding all those long-term Treasury bonds and MBS, which are assets, also decreases as the balance sheet shrinks. Which effect dominates depends on the level of interest rates and the speed of QT.
So it could go either way.
It could. In a standard QT scenario, maybe the reduction in interest paid on reserves dominates, potentially increasing remittances to the Treasury. But really aggressive QT, by shrinking the asset base quickly while rates are high, could easily reverse this, or even push the Fed into an operating loss.
And if the Fed has a loss?
Then there are no remittances to the Treasury. That means the government has to borrow more or find revenue elsewhere, putting further stress on the fiscal situation. It's another feedback loop.
Okay, so pulling all this together on the fiscal monetary mix.
Yeah.
What's the main takeaway from the sources about managing this whole QT process?
The core message, really hammered home by the findings, is that with these unconventional policies like QE and QT, close coordination between the fiscal authorities, Congress, Treasury, and the monetary authority, the Fed, isn't just like nice to have, it's essential.
Especially in certain situations.
Especially, as the sources put it, if we find ourselves in something resembling that fiscally led regime. In that situation, without appropriate fiscal adjustments, think tax increases or spending cuts aimed at putting government debt on a clearly sustainable path, simply shrinking the Fed's balance sheet via QT might not be effective at all in bringing inflation back down to target.
It really underscores that interdependence.
Massively. Especially in today's world with high debt and stubborn inflation, government spending and taxing decisions matter immensely for what the central bank can achieve with its balance sheet.
Okay, let's shift gears slightly. How does all this, the rising rates, the QT process, how does it affect the broader market environment and financial stability beyond just housing?
Well, the sources are pretty clear that QT, by its very nature, adds another layer of risk. It's another tightening lever being pulled in what's already described as a difficult, sensitive, and pretty volatile market environment.
How does it add risk?
By withdrawing liquidity from the financial system and putting upward pressure on long-term rates, it increases the potential for market dislocations, for, something to break somewhere in the financial plumbing due to the overall tightening of financial conditions. It raises the risk of over-tightening, leading to unintended negative consequences.
And this isn't like the last time the Fed tried QT, is it? Back in, 2017 to 2019?
That felt much calmer.
Massively different environment. The sources explicitly draw that contrast. That 2017-2019 QT attempt was much more gradual, and it happened during a period of relatively low inflation, slow and steady rate hikes, pretty stable economic growth, and crucially, few major external shocks.
Yeah, today?
Today is the opposite on almost all fronts, right? We have multi-decade high inflation driving aggressive tightening across the board, both rates and the balance sheet simultaneously. We have rising recession risks globally. We have major lingering shocks like the aftereffects of COVID, the war in Ukraine, the European energy situation.
Yeah, a lot going on. All these factors just amplify the potential for QT to contribute to market volatility and stress in a way that wasn't really a concern back in 2018.
Are we actually seeing signs of that market stress already, particularly in really important markets like U.S. Treasuries?
Yes, the sources indicate that market risk and liquidity indicators, especially within the crucial U.S. Treasury market, the bedrock of the global financial system, have already shown moderate signs of stress.
Mostly from the rate hikes.
That's certainly a primary driver, the sheer speed and size of the rate hikes, but QT is expected to contribute further to potentially poor liquidity conditions as it continues to withdraw that Fed backstop.
What kind of indicators are flashing yellow, so to speak?
The sources point to a few specific ones, things like the spread between the GCF overnight repo rate and the interest on reserve balances, IORB rate, that can signal stress in the very short-term plumbing the funding markets banks use daily. They also mention the 3-month FRA versus OIS spread. That's a key gauge of perceived risk and health in the market for unsecured lending between banks. Wider spreads mean more perceived risk.
Got it. Anything else?
And probably the one most familiar to listeners, the MOV index. It's basically the bond market's equivalent of the VIX stock market volatility index. It tracks expected volatility in treasury prices, and it has shown pretty elevated levels, reflecting increased uncertainty and bigger price swings in the government bond market.
And we didn't just see indicators, did we? We had a real-world stress event fairly recently that seemed to show some of these vulnerabilities under this new regime. The banking mini-crisis in March 2023.
That's a perfect, though painful example. The banking mini-crisis, kicked off by Silicon Valley Bank's failure, was partly a direct consequence of this rapid rise in interest rates. Many banks, especially regional ones like SVB, were holding large portfolios of long-duration treasury bonds and MBS that they'd bought back when rates were near zero during the QE era.
Assets that look safe then.
Exactly. But as rates surged because of the Fed's tightening both the hikes and the upward pressure on yields from QT expectations, the market value of those safe bonds just plummeted. In some cases, they lost around 30% of their value.
Huge unrealized losses.
Huge unrealized losses sitting on bank balance sheets. And critically, because the Fed wasn't actively buying bonds anymore through QE, and it was actually withdrawing demand via QT, there was no Fed backstop propping up those bond prices like there might have been previously.
So depositors got nervous.
Exactly. When depositors got spooked, partly by seeing these unrealized losses, the banks faced a classic bank run dynamic, but it was made much worse because the assets they needed to sell to meet withdrawals were worth so much less. It really highlighted a key vulnerability in the system under this new, tighter policy regime. The Fed wasn't the buyer of last resort in the same way.
So playing this forward, if market liquidity conditions really started to deteriorate badly, like severe stress, threatening broader financial stability, what would central banks like the Fed likely do? Would they just stick rigidly to their QT plan no matter what?
The sources suggest probably not. If liquidity conditions become truly severe, posing a genuine threat to the stability of the whole financial system, central banks might be forced to temporarily shift their priorities.
Away from inflation fighting.
Potentially, yes. They might have to prioritize relieving those intense short-term market pressures and restoring basic functioning and stability, even if it means pausing or adjusting the QT process. It's about choosing the lesser of two evils in a crisis moment.
Have we seen this happen?
We saw a very prominent example with the Bank of England in late 2022. Remember, the UK government bond market, the gilt market, went into a tailspin after a controversial fiscal announcement.
Yeah, the mini-budget crisis.
Right. The volatility became so severe it threatened pension funds. The Bank of England, even though they were supposed to be tightening policy and starting their own QT, had to step back in as an emergency buyer of gilts for a short period just to restore order. It shows that financial stability concerns can override the tightening mandate in extreme circumstances.
Okay, so for investors listening to this, trying to navigate this volatile environment that's made even more complex by QT, should they be making big changes to their portfolios based just on QT?
The sources generally advise against making huge, sweeping changes solely because of QT. It's definitely a significant factor, a headwind for markets, but it interacts with so many other things: inflation, growth, geopolitics, fiscal policy.
Right, it's one piece of a big puzzle.
Exactly. However, what the sources do strongly suggest is that now is a particularly good time for investors to really strengthen their stress tests, especially around portfolio liquidity.
Meaning what?
Meaning really understand how your portfolio might perform if market stress suddenly spikes. Would you have enough access to cash? Or could you be forced to sell assets at really bad distressed prices just to meet obligations or margin calls?
Planning for the worst case scenario.
Kind of. It's also a good time to double check that your portfolio is genuinely well diversified across different asset classes, geographies, and potential economic outcomes.
Is there an opportunity side to this?
Potentially. While central banks probably have a higher tolerance for market bumps and volatility now compared to the QE era, given their intense focus on inflation.
It will rescue markets from every little dip.
Probably not. But they are still expected to intervene forcefully in truly severe episodes like the buoy did. If you're positioned correctly diversified, With some liquidity, you might be able to take advantage of opportunities that arise during periods of major market dislocation, especially if they're followed by a central bank response that could cause sharp, unexpected rebounds in asset prices. It's about resilience and readiness.
Okay, let's zoom out one last time. We've talked domestic markets, housing, fiscal policy. What about the global angle? How does U.S. QT and the whole U.S. monetary policy stance feed into the value of the U.S. dollar on the world stage?
Right, the dollar, its value relative to other global currencies is driven by a really complex mix of factors.
Like what?
Well, you have the global flow of investor savings, whereas capital looking for a home. You have the issuance of new assets, government bonds, corporate stocks around the world. You definitely have monetary policies, differences in interest rates between countries, but also things like central bank reserve holdings, including QE and QT. And crucially, you have shifts in global investor demand or preference for assets denominated in different currencies.
And the dollar's been pretty strong for a while now, hasn't it? Especially after the financial crisis.
It has, yes. Particularly in that period from roughly 2010 up to 2021, the dollar saw a significant appreciation against other major developed market currencies.
And the sources tried to figure out why. What drove that strength?
They did. They broke down the drivers during that specific time frame. Global investor savings patterns, things like the U.S. being seen as a relatively safe and attractive place to invest capital, contributed about 14% of that appreciation.
Okay, that's one piece.
But importantly, shifts in investor demand contributed an even larger chunk, about 11%.
What kind of demand shifts?
Yeah.
Demand for U.S. stuff?
Essentially, yes. The analysis found a key pattern post-crisis where foreign investors became increasingly willing to buy U.S. assets, maybe even accepting slightly lower returns compared to similar assets elsewhere, perhaps due to perceived safety or liquidity.
Okay, foreigners wanted more U.S. assets.
And at the same time, U.S. investors actually shifted somewhat away from foreign assets compared to before. So you had this dual demand shift, more foreign demand for U.S. assets, less U.S. demand for foreign assets. That combination was a powerful force pushing the dollar's value up.
Interesting. It highlights that whole dollar dominance or dollar hegemony idea.
It really does. It speaks to the enduring stability and attractiveness of the dollar as the world's main reserve and transaction currency, even through periods of crisis and unconventional policy.
So how did U.S. monetary policy itself, like interest rates and QE/QT, fit into that dollar strength story during 2010-2021?
Over that specific period, the analysis showed that higher U.S. interest rates relative to rates in other developed countries did contribute positively to the dollar's appreciation, as you'd expect. Money flows to higher yields.
Makes sense.
Conversely, lower foreign rates contributed negatively, meaning they also pushed the dollar up. However, the overall net effect just from interest rate differentials was actually relatively small compared to the impact from those bigger savings patterns and especially those investor demand shifts we just talked about.
So rates mattered, but less than demand preferences.
In that period, yes, according to this analysis. And interestingly, changes in global central bank reserve holdings. So how many dollars other central banks around the world were choosing to hold in their official reserves? That factor actually had a small negative contribution to dollar appreciation over that decade, meaning global central banks were, on the margin, slightly diversifying away from dollars in their reserves. That would typically put downward pressure on the dollar, but it was more than swamped by those other positive factors like strong investor demand.
Okay. And you mentioned earlier, when we were talking about QT hitting the MBS market, this concept of asset demand elasticities. Does that apply here too in the global context?
It absolutely does. And it's really key to understanding how big shifts in supply and demand, like those driven by QE and QT, ripple through different markets and affect prices and yields, which then influences capital flows and the dollar.
Remind me what elasticity means here again.
It's basically how sensitive an asset's price is to a change in its supply or demand. High elasticity means the price doesn't move much, even if supply or demand changes a lot. Low elasticity means the price moves a lot in response to a supply or demand shift.
Okay. And different assets have different elasticities.
Hugely different. Short-term debt, like Treasury bills, is highly elastic. The sources cite a number like 313. That means even big changes in supply or demand for T-bills have very little impact on their price or yield. The market can absorb it easily.
Right. But long-term debt.
Long-term debt, which includes the Treasury bonds and mortgage-backed securities that were the focus of QE and QT, is much less elastic. The sources give figures like 4.3 for long-term debt and even lower, 2.7 for equities.
Much lower numbers.
Meaning
they're more sensitive.
Exactly. Much more sensitive. That lower elasticity for long-term bonds means that the massive changes in supply and demand, driven by the Fed's balance sheet operations, buying trillions during QE, now withdrawing demand during QT, have a much bigger punch. They move prices and yields much more significantly.
Which is why QT hit MBS yields so hard.
Precisely. And those bigger swings in U.S. bond yields then impact everything from domestic mortgage costs, as we discussed, to the relative attractiveness of holding U.S. long-term assets compared to foreign ones. That feeds back into global capital flows and influences the dollar's value. So it's another channel, maybe a complex one, but another channel through which QT has tangible global effects.
Okay, wow. So let's try and pull this all together. What does it all mean? It feels like quantitative tightening isn't just some minor technical footnote in Fed policy.
Definitely not.
It's a really powerful, complex tool. It has these far-reaching, sometimes unpredictable consequences that are still playing out right now.
That seems fair to say.
We've seen its significant impact, maybe even a magnified impact, on the housing market, contributing to that affordability crisis, the market gridlock.
The QT surtax idea.
We've explored how its interaction with government finances has these echoes of historical challenges from decades ago, highlighting that constant tension between monetary and fiscal policy.
The post-WWII parallels, yeah.
We've seen modeling that suggests its very effectiveness in fighting inflation might depend critically on that broader fiscal landscape, maybe more than we typically think.
The whole regime dependence finding.
And we've touched on how it even plays this subtle but measurable role in the global value of the dollar by influencing dynamics in key bond markets. It just adds layers of risk and volatility to markets that are already juggling a lot of complex global factors.
Yeah. It complicates an already complicated picture. And that historical perspective really sticks with you, doesn't it? History seems to teach us that those fiscal considerations, the government's debt and deficits, they become incredibly hard for a central bank to ignore once it's been deeply involved in keeping government borrowing costs low.
Right.
And the threat to long-run price stability, it really grows when large fiscal deficits just keep rolling on year after year, potentially testing the central bank's practical independence, even if its legal independence is enshrined.
So thinking about where we are now, given the current high levels of public debt, given the different potential fiscal monetary regimes we talked about, maybe the ultimate path of unwinding these huge central bank balance sheets, and maybe even the future path of inflation itself, does it ultimately hinge more on the fiscal choices the government makes on taxes, on spending, than it does on the precise mechanics of the central bank's balance sheet alone?
That's a powerful question to end on. It's definitely something crucial to consider as we watch all these powerful dynamics continue to unfold in the economy and the markets around us.